When we see elite athletes, we usually focus on their insane physical talents, championship rings, and multi-million-dollar contracts. However, the world of professional sports is actually a brutal financial ecosystem. Pro athletes experience a completely reverse career trajectory compared to traditional professions. They earn the absolute maximum amount of their lifetime wealth in their 20s and early 30s, facing a sharp retirement deadline before most people even hit their professional stride, because an injury or a sudden drop in performance can end a multi-million-dollar cash flow overnight. The elite athletes who successfully protect and multiply their fortunes rely on highly strategic wealth principles. By studying how the world's highest-paid figures manage, invest, and scale their income, we can extract powerful financial blueprints that apply directly to everyday wealth building. 1. Shift from active labor to scalable intellectual property. The most critical financial transition an elite athlete can make is shifting away from trading their time and physical labor for a paycheck. In professional sports, even the highest on-field salaries are structurally limited by time, age, and contract lengths. True billionaires in the sports world recognize that long-term financial freedom requires building assets that generate revenue completely independent of their physical presence. This is why global icons focus aggressively on commercial licensing, trademark monetization, and equity-driven brand partnerships. By transforming a personal reputation into a scalable corporate brand, an individual can capture global consumer dollars around the clock. When a consumer purchases a branded product or subscribes to a media platform, the creator collects a direct royalty percentage without having to manage daily production, global shipping logistics, or manufacturing overhead. The ultimate wealth lesson here is clear. To build true generational wealth, you must eventually stop relying solely on a direct salary and focus on creating or owning scalable intellectual property that works for you while you sleep. 2. Treat personal talents as a business entity. Ultra-successful athletes do not view themselves merely as employees of a league or a franchise. Instead, they treat their personal name, talents, and career output as a highly structured corporate entity. This mindset shift changes how every single dollar coming in is handled, turning personal income into corporate revenue that must be managed with extreme fiscal discipline. By operating through a corporate framework, elite performers can aggressively minimize their tax liabilities, write off legitimate business expenses, and protect their core assets from external liabilities. Furthermore, treating yourself as a business means assembling a highly specialized professional team to manage different operational sectors. Successful figures do not try to handle complex financial planning, multi-state tax compliance, legal contracts, and asset management on their own. They hire vetted accountants, corporate attorneys, and specialized wealth strategists to act as financial gatekeepers. This approach teaches us that managing wealth effectively requires moving past emotional decision-making and running your personal finances with the same structure, accountability, and professional oversight as a high-performing corporation. 3. Mitigate extreme income volatility through structural defensiveness. The average career length in professional sports is incredibly short, often lasting less than 6 years due to injuries, roster cuts, or age-related performance declines. Because their primary cash flow is highly volatile and bound to a strict expiration date, financially savvy athletes prioritize defensive wealth structures before chasing high-risk investments. They understand that when you experience sudden, high-volume income, your immediate goal must be protecting your baseline security rather than over-leveraging into speculative markets. To build an unbreakable financial shield, elite performers establish substantial cash reserves capable of funding multiple years of lifestyle expenses. They also invest heavily in comprehensive disability and asset protection insurance policies to safeguard their future earning potential against unexpected physical setbacks. This defensive strategy proves that true financial strength is not just about how much money you can generate during a peak season. It is entirely about how much structural stability you put in place to ensure that a sudden loss of primary income cannot compromise your long-term wealth. 4. Separate lifestyle inflation from core capital allocation. Receiving a massive financial windfall often triggers immediate lifestyle inflation, tempting individuals to overspend on high-maintenance luxury assets like mansions, exotic sports cars, and private travel. Elite athletes who maintain their wealth over decades understand that depreciating luxury items are net cash drains that demand permanent expensive upkeep. If a disproportionate amount of capital is locked into liabilities that actively lose value, the core wealth engine eventually starves. Disciplined wealth builders manage this pressure by establishing a strict, segregated capital allocation plan. They divide incoming revenue into clear, non-negotiable pools, ensuring that the vast majority of their earnings are routed directly into income-producing assets before any discretionary spending occurs. They intentionally maintain their baseline living expenses far below their actual earning capacity during peak years. This financial boundary ensures that their lifestyle is funded by the passive yield of their investments rather than the temporary capital generated by their daily labor. 5. Build an uncompromising family financial framework. Sudden wealth inevitably brings immense external pressure from friends, extended family, and acquaintances seeking loans, handouts, or financial backing for unvetted business ideas. Many talented individuals have seen their fortunes completely eroded because they felt emotionally obligated to fund every request that came their way. The athletes who survive this pressure do not simply cut off their loved ones. Instead, they implement a formal, structured framework for family financial assistance. To remove emotion from financial boundaries, top-tier wealth managers help clients establish dedicated, capped family assistance funds governed by strict protocol. By allocating a specific, fixed amount of capital to an independent account, the individual can provide meaningful support to their community without risking their core retirement portfolio. If a request exceeds the preset boundaries of the fund, it is systematically denied by the financial team rather than the individual. This approach demonstrates that protecting your wealth requires setting professional boundaries, preventing unstructured handouts from quietly draining your long-term capital reserves. 6. Prioritize boring income-producing baselines over speculative deals. It is incredibly common for young, wealthy individuals to be targeted by promoters pitching high-risk startups, speculative tech ventures, or complicated private equity deals that promise overnight riches. While media headlines tend to focus on the rare occasions an athlete strikes gold with venture capital investment, the reality is that most speculative private deals fail. The most financially secure individuals build their portfolios from the ground up by prioritizing highly stable, predictable asset classes. Before committing capital to high-risk business ventures, experienced investors build a massive foundational baseline using high-quality real estate holdings, fixed-income instruments, and diversified index funds. These assets provide consistent, reliable cash flow and steady compounding over long periods. Only after a secure, lifestyle-covering financial floor is firmly established do they allocate a small, discretionary percentage of capital to speculative, high-reward business opportunities. This disciplined sequencing ensures that even if a risky business venture goes completely to zero, their underlying financial security remains totally untouched. 7. Leverage sweat equity and endorsement portfolios into ownership stakes. Traditional endorsement deals involve an individual receiving a fixed cash fee to promote a corporation's product for a specific period. While this provides immediate liquidity, it ultimately leaves a long-term enterprise value in the hands of the corporation. Elite figures who understand modern wealth building have completely revolutionized this model by demanding direct equity ownership stakes, revenue sharing agreements, or stock options in exchange for their marketing power and personal association. By trading their publicity and cultural influence for corporate equity, individuals become actual owners of the business entities they help scale. This strategy allows them to capture massive capital gains whenever the company experiences an acquisition, public offering, or valuation increase. This concept of earning your way into equity rather than just collecting a flat fee teaches a powerful lesson. Whenever you contribute significant value, talent, or audience attention to a business enterprise, you should always seek to align your compensation with the long-term equity growth of the company. 8. Plan for an aggressive and productive second act. True financial retirement for an elite athlete typically arrives in their mid-30s, an age when professionals in other industries are just entering their peak earning years. The individuals who maintain high wealth levels and personal fulfillment do not simply stop working to live a life of passive leisure. They recognize that a decades-long retirement without focus can lead to financial stagnation, aimless lifestyle spending, and rapid wealth depletion. Therefore, they spend the final years of their active careers aggressively preparing for a secondary entrepreneurial path. This second act strategy involves transforming accumulated capital, global networks, and personal branding into active business platforms, media production companies, real estate development groups, or institutional investment funds. By treating the end of their primary career as a transition into full-time business leadership, they ensure that their mind remains occupied and their capital continues to be deployed productively. The ultimate wealth lesson here is that financial independence is not about reaching a permanent state of total inactivity. It is about securing the ultimate freedom to choose exactly how, where, and with whom you deploy your time, energy, and capital for the rest of your life.